Joining us now for a look at the virus's impact on airline stocks is Savi Syth, Raymond James airline analyst. Nice to see you this morning, Savi. So what do you think we should be thinking about as airline investors this morning if we're holding these stocks, specifically United?
Yeah, I think right now things are very contained, and I think it's worth keeping a close eye on it. And if it does become more of a pandemic, I think it's instructive to look at what happened with SARS or H1N1. And in those cases, you had revenues from those regions decline significantly, but only over kind of a 8 months time frame, assuming that this can be kind of handled as we did with SARS and H1N1. In that 8-month period, only 5 months did you see kind of double-digit declines, and they were declines of 10 to 40%. So it's worth monitoring. But for kind of longer-term investors, the understanding here is these tend to be relatively kind of shorter-term impacts on the overall industry. And importantly, the U.S. airlines are much stronger this time around with good balance sheets and healthy margins, so that they are in a better position to kind of withstand an impact.
Though it's kind of a double whammy, if you will. You're already dealing with the Boeing and the 737 MAX issue. Not that there's ever a good time for anything like this, but this would seem to me to be an especially bad one, just given some of the, the underlying issues that are facing the industry today because of the Boeing issues.
With the Boeing issue, I think it's more impacting from a lost opportunity standpoint, lost opportunity from revenue, lost opportunity from kind of cost savings that the fuel efficiency and that the Boeing plane would, the MAX aircraft would offer these airlines that are missing their aircraft, and it's also really tough for kind of the pilots and the flight attendants who are kind of not finding as much hours just because the airlines aren't growing as much. That said, it's not really hurting margins and balance sheets in a kind of overly negative way. In fact, it's probably helping yields for the market overall. So I think this is something, again, it's a tragic event, and especially if it becomes worse. But from an airline perspective, I think this is something that they're in a good position to handle.
Have we ever seen an airline go bankrupt because of something like this, Savi? I'm thinking, as an investor, you start to see these stocks decline, and if you start to buy thinking, you know what, they have recovered every single time something like this has ever happened, then you just dollar cost average, even if it keeps going down. In theory, there's a recovery on the other side, unless one of them were to actually fail. Have we ever seen that?
No, and in fact, H1N1 happened during the kind of global financial
crisis,
financial recession, and so and during that time, you didn't see a single airline, as a U.S. airline, declare bankruptcy. So, and the group is in a much stronger position today with much better balance sheets and liquidity position. So I think the probability is very low that this could send anybody into a bankruptcy situation.
So then if the sell-off in these stocks becomes more severe, you'd be a buyer, sounds like.
Yes. Exactly. It's too early now to kind of go in a big way because this could get worse. But like I said, it's usually 8 months, and there's about 5 months in there. That could be kind of double-digit declines in revenue in that region. But I would see it as a buying opportunity.
Understood. Have a good weekend, Savi. We'll talk to you soon.
All right. You too.
All right. That's Savi Syth with us today from Raymond James.
It was startling. I don't know if you saw the graphic that we put up during that segment, the increase in travel by the Chinese, and now it's to 611 million, but not going back that far when they weren't permitted to travel. I mean, look at that extraordinary growth. 1990 was almost zero because of the tight communist control on people there. It's crazy.
So one of the things to talk about these airlines, and just full disclosure.
Yeah, you're a holder of several.
We own Delta and United. So if you look at Delta, I mean, they're not as exposed to the Far East. Great balance sheet. Their earnings were very strong. They've got a 3% dividend yield, investment grade. And I think oil prices coming down is going to help them as well. So that's kind of the blue chip of the airlines to own if you do get a sell-off in there. I'd probably add more to my positions in there. United is more exposed to the Far East. They've already been hit by Hong Kong. They actually called that out in their earnings call, but they still had pretty strong earnings. So if you think about all the travel that was going on in Hong Kong, China will affect them as well. And this is, I think, is a better stock to play if this whole sector comes down, because they actually have the most exposure, more volatility, but they'll do better in the long term.
That's the blessing and the curse of what United has done. You want to own a stock like that. Their business is so favored because they have expanded so broadly into the Far East and Asia.
Exactly.
But yet when something like this happens, then they end up as more exposed than most.
And what happens is that's why these stocks trade at 8 or 9 times earnings. You're not going to get the market multiple. Similar to the financials, there's always something that happens, global, geopolitical, and then these stocks get hurt pretty quickly because the first things investors do is short this or sell the ETF and kind of come back, ask questions later. As a long-term investor, these are the opportunities that when people say, well, what are the stocks that get really hit? Well, look for these. It's going to be hard to buy them if things get worse. But if you're looking out a year or 2 years down, these are the opportunities you want.
United flat in the pre-market this morning after a soft week.